most people still imagine power the old way: presidents, armies, orders, flags.
They imagine power as something visible, something theatrical, something that announces itself. A capital city, a convoy, a speech, a war room, a decision signed in public and carried out in full view of the world. But some of the most important power in the modern world no longer looks like power at all. It does not need uniforms. It does not need monuments. It does not need ceremony. It looks like systems. It looks like infrastructure. It looks like risk. It looks like code, coordination, and quiet institutional trust. It looks like the hidden architecture that allows markets to function, capital to move, and complex organizations to make decisions at scale. And because it looks so technical, so procedural, so neutral, most people never notice how much influence is sitting inside it. And if you follow modern capital long enough, you eventually run into BlackRock, a private firm that does not govern a nation, does not produce the everyday products people live with, and does not own the world in the old dynastic sense. Yet over time, it moved into a position few firms ever reach. Not simply successful, not simply large, but structurally important. Important enough that the story is no longer just about money. It becomes a story about position, dependence, and the invisible operating layer of modern capitalism. This is not a conspiracy story. And it is not a corporate fairy tale either. Because the real story lives in the uncomfortable space between ownership, influence, technology, and trust. Too much of the public conversation about BlackRock collapses into lazy extremes. Either the firm becomes a cartoon villain that secretly controls everything, or it becomes a sterile service provider with no real influence at all. Neither reading is serious enough, and neither one tells you much about how modern power actually works. Before BlackRock became a systemic giant, Larry Fink was a rising figure on Wall Street, inside a market obsessed with financial innovation. This was a period when complexity felt exciting. New instruments, new structures, new ways of packaging risk and return. Finance did not see itself as fragile. It saw itself as clever. And for a while, that cleverness looked like control. Markets rewarded speed. They rewarded confidence. They rewarded the appearance of mastery. That was the environment that shaped the people who would go on to build BlackRock. Then came the wound, a bad interest rate bet, and a loss big enough to permanently change the way he thought about risk. For most people, a loss like that would be remembered as a career setback. For Larry Fink, it became something deeper, a humiliation, a mental reset, a lesson harsh enough to rewrite the logic that came after it. Because what that moment revealed was not just that markets were dangerous. It revealed that increasingly complex markets could punish smart people with shocking speed. That failure revealed something brutal. Complexity was not control. A market can become more sophisticated and less legible at the same time. It can produce more instruments, more velocity, more layers, and still make itself harder to understand when stress arrives. That is the trap. People mistake intricacy for mastery. They mistake movement for clarity. They mistake confidence for visibility. But when systems get dense enough, blindness can hide inside sophistication. If markets were becoming more opaque, more interconnected, and faster, then survival would belong to whoever could read risk better than everyone else. That is the real beginning of the BlackRock story. Not glamour, not ambition in the theatrical sense, not the dream of building a financial empire for its own sake. The founding logic was more severe than that. If the future of finance was going to be more complex, then the winning institutions would not just be the ones that bought assets well, they would be the ones that understood fragility better than the rest. BlackRock was founded in 1988 by Larry Fink and 7 partners, built around discipline, fixed income, and risk management. At first glance, that language sounded technical, almost modest. Nothing about it suggested spectacle. Nothing about it suggested mythology. But underneath that disciplined surface was a major strategic insight. If markets were becoming harder to read, then the ability to see structure before others saw chaos would become a serious advantage. And in time, more than an advantage, a position. Most firms wanted to sell performance. BlackRock wanted to sell confidence. Not confidence in the cheap sense, not optimism, not the promise that returns would always rise. A deeper kind of confidence. Confidence that someone was not only chasing performance, but examining what could break beneath it. Confidence that someone was not only buying exposure, but measuring hidden vulnerability inside the exposure. Confidence that discipline would matter more than style when the system came under pressure. Not confidence that returns would always rise, but confidence that someone was mapping the fragility hidden inside those returns. That is a very different business. It means looking past the surface of performance and into the structure beneath it. Correlation, liquidity, mismatch, exposure, stress, contagion. It means treating success not as a destination, but as a system that could fail under the wrong conditions. And that mindset matters, because modern markets are rarely destroyed by what is obvious. They are usually damaged by what looked manageable until it suddenly wasn't. That is where BlackRock's real weapon began to take shape. Aladdin. And this is where shallow explanations of BlackRock usually miss the point. People look at the size of the firm and assume the entire story is scale. It isn't. Scale matters, obviously. But scale becomes something more powerful when it fuses with information. Aladdin was not important because it sounded sophisticated. It was important because it helped transform risk into something that could be monitored, organized, and acted on at institutional scale. Not just software, but a way of organizing financial reality before panic made that reality unreadable. That is a much bigger claim than calling it a platform, because a platform can be a tool. This was closer to a way of seeing. A way of asking where the vulnerabilities were hiding inside enormous portfolios, where correlation was tighter than it looked, where liquidity could vanish, where liabilities and exposures stopped matching cleanly under pressure. In other words, Aladdin was not merely watching the market, it was helping institutions interpret it. And once other institutions started relying on that kind of visibility, BlackRock stopped looking like just another market participant. It began to look like infrastructure. That transition is one of the most important things in the entire story, because a company can be highly competent and still remain just another competitor. But when the same company starts providing part of the analytical layer other institutions rely on, its position changes. It no longer sits only inside the system. It starts to become part of how the system reads itself. That is quieter than ownership, and in some ways, more sophisticated. By the time Aladdin was serving more than 1,000 clients, the story had shifted from scale to dependency. That detail matters because dependence is a different category of power. Money can make you large. Dependency can make you structural. And once major institutions begin relying on the same technical layer to understand portfolios, manage risk, and process complexity, influence stops looking theatrical. It starts looking procedural. It starts looking neutral. It starts looking like the normal operation of a system that no longer knows how to function cleanly without those tools. Then came the move that changed BlackRock's scale forever. The 2009 acquisition of Barclays Global Investors, including iShares. That deal did not just make the firm bigger, it changed the category BlackRock was operating in. Because iShares was not a side business. It was one of the most important ETF platforms in the world. And ETFs matter here for a simple reason. They sit close to the everyday mechanics of how huge amounts of capital reach markets. That means the acquisition was not just about size, It was about deeper integration into the plumbing. That move pushed BlackRock deeper into the everyday plumbing of modern asset allocation. From that point on, the firm was not simply managing assets, offering advice, or building technology. It was participating more deeply in the channels through which institutions and millions of investors actually access the market. And that changes perception. Because once a company is no longer just present at the edges of the system, but increasingly embedded in its operating mechanics, it begins to feel less like a brand and more like a structural layer. Less optional, more inevitable. Then the crisis of 2008 turned legibility into power. On the surface, it was a crisis of credit, leverage, and collapsing institutions. At a deeper level, it was also a crisis of readability. Assets that had once been treated as stable became suspect. Confidence disappeared. And entire segments of the financial system became hard to value, hard to trust, and hard to interpret. That matters because in complex systems, unreadability is not a side issue. It is a form of danger. And when danger becomes illegible, the institutions that can restore legibility gain a different kind of importance. When legibility collapses inside a complex system, power moves toward whoever can restore it. That is one of the deepest patterns in this story. Not power in the theatrical sense, not domination with a flag attached to it, a more modern kind of power. The power of being useful when the rest of the system can no longer see clearly. The power of being trusted to interpret complexity when others are losing their grip on it. The power of reducing panic by turning chaos back into something institutions can work with. That is the kind of position crises tend to reward. That is why BlackRock's role during the crisis mattered. Not because it looked dramatic, but because usefulness in chaos becomes institutional capital. This is what many people miss when they think about financial power. In moments of stress, the institutions that can help stabilize complexity gain more than revenue. They gain access. They gain trust. They gain repetition. And repetition matters. Because in finance, recurrence is one of the most valuable forms of power there is. Not visibility, not headlines. Recurrence. Being called again. Being relied on again. Being folded more deeply into the system the next time pressure returns. This is where lazy interpretations fail. BlackRock does not literally own the world, but it does sit unusually close to capital flows, voting power, risk systems, and institutional decision-making. That is a more serious claim than the cartoon version, and it is more difficult to dismiss. Modern power does not always depend on outright ownership. It often depends on structural position. Close enough to the flow to matter. Close enough to the system to shape outcomes. Close enough to coordination, trust, and scale that the line between participant and architecture starts to blur. Its influence feels credible precisely because it presents itself as technical, neutral, and useful. No troops, no slogans, no imperial theater. Just data, governance, risk, infrastructure, scale. And that may be one of the defining signatures of 21st century power. The less it resembles old imperial imagery, the easier it becomes to mistake it for neutral process. But neutral process, when it sits close enough to capital and decision-making, can still carry enormous consequence. So the real question was never whether BlackRock controls the world. That question is too loud, too simple, and ultimately too shallow. The better question is this: what happens when modern capitalism becomes too vast, too technical, and too fragile to function without private systems that help it understand itself? What happens when markets no longer depend only on buyers and sellers, but on the analytical and technological layers that allow those buyers and sellers to interpret complexity in the first place? What happens when the system becomes harder to read without private infrastructure embedded inside it? That is the more serious question. Because once a firm becomes useful at that level, it no longer looks like a company in the ordinary sense. It starts to look like infrastructure. And that may be the most important thing BlackRock represents. Not a cartoon villain, not a dynasty, not a government, but a prototype.
A prototype of 21st century power. Technical, private, systemic, and close enough to the flow to shape outcomes without ever needing to look imperial. That is why the story matters. Not because it confirms a fantasy, but because it reveals a pattern.
The age of visible empires did not disappear, but it was joined by something quieter, colder, and in some ways more adaptable. Power that presents itself as system design.
BlackRock helps organize the capital of the present, but the next battle for power will also be fought in chips, fabs, energy, and silicon.
Because capital alone does not define the future. The industrial brain beneath the digital age matters too. If you want to understand how power really works beneath the surface, through capital, systems, infrastructure, and strategy, subscribe to Mechanics of Power. And if this video helped you see the system more clearly, share it with someone who still thinks power only looks like flags, speeches, and headlines. Because the machinery shaping this century is rarely visible at first glance. But it is visible if you know where to look.